So welcome to today's webinar. So the presentation has been prepared. It is presented by our independent expert. So the views presented are not necessarily the views of Multiple Sclerosis Limited, and we do encourage you all to seek further advice regarding the relevance of the information presented for your own situation. So welcome, Mirko.
Okay, good morning. My name is Mirko Klodja. I'm what's called a Financial Information Service Officer with the Box Hill office of Centrelink, and today I'm going to talk to you about the asset test changes coming into effect from 1 January 2017. Now, very briefly though, we'd like to acknowledge the country, we'd like to show our respect and acknowledge the traditional owners on whose lands we meet today. We pay our respects to their elders past and present. Now, very briefly about the Financial Information Service, for those of you who may not be familiar, we are a service accessible information for all Australians. We are free, confidential and available to everyone. Ideally, we'd love to see people in their early 30s and stuff before they become older, because we can help people understand their financial options, financial planning principles, tax, social security implications, superannuation investment choices. We have roughly 26 topics that we go out around Australia and present to people. Unfortunately, the vast majority of people come to us when it's pension time and they don't really have a chance to improve their lifestyle. What we're not allowed to do is advise or recommend a particular product or provider, and I personally find that a bit of a problem because I used to be in the finance industry and I was sent to a provider who was basically railroading everybody by sending him into a very bad fund. He got upfront commissions and that fund actually failed a few years later. So, and by the way, he's still out there working. So I find that a bit of a shame. And the other thing we don't do is we don't tell you what to do with your money. That is totally up to you. You may remember the woman that won $7 million at Crown Casino. She was invited back and lost it a few weeks later when she came to Centrelink. All we could tell was how much new start she could get. We couldn't do anything else for her. So we're all about financial information, not advice. Even though most of our staff are trained as financial planners, we're not legally allowed to do it because Centrelink does not allow our staff to do that. Now, in today's presentation, we'll look at why are things changing, the maximum rate of pension, current income and asset tests, and what's going to happen from 1 January 2017. We have some examples. Now, one of the things you need to be aware of is the government has no choice. Basically, they've got to change things. Because at the moment, 13.4% of our population is age pensioners. By 2050, we are going to have 23% of the population will be over 65. And believe it or not, the fastest growing group in the entire lot is 100-year-olds. At the moment, we have 1,790 100-year-olds. By 2050, we're going to have 50,000 plus 100-year-olds. So we are going to find it very hard to keep paying taxes and things. So as a result, the government is looking at ways of reducing their expenditure now. So they're going to be changing the assets test. Now, I do have to tell you that this information is current as of today, but it will be different for everybody. Even if I had 3 people with the same income and assets on paper, they could get a different result. Because if you had all your money in super or savings, you'd be tested differently if somebody had a holiday home or had a rental property. So even though your paper value might be $1 million each or $500,000, you could end up with different pension rates depending on how you held those assets. So today it's a very generic presentation. Now, what the government's looking at is why are they changing? They need to try to balance the budget. They're trying to do jobs growth and increasing the amount of people that get the submarines being built. They've got new industries developing around Australia. They're also targeting tax avoidance and looking at our superannuation system to try and make it more sustainable, and they're trying to get smaller government. As it shows there on the corner, we had 167,596 public servants in 2006-07. It peaked at 182,505 in 2012. We're back down to 167,155. The government is reducing the amount of employees it has to reduce the expenditure and that side of things. And unfortunately, some of you may not like it, eventually Centrelink will be like the passports office. 99% of it will be done online. We are currently trying to get as many people online as possible because our staff are getting older and we are finding it very difficult to get young staff to come in and stay. Where I work at Box Hill, probably 70% of the staff are in their mid-50s at the moment. We'll find it very difficult to get young staff to stay, so you will find that more and more you will have to be using the internet in the future. So at the moment, today, we have 2.4 million pensioners. The government is spending $40 billion a year on the age pension payments. Also, greater benefits are going through Medicare safety net and pension benefit concessions. So the government is also giving a Commonwealth healthcare card to people who don't qualify for the age pension, so that increases the expenditure there. And home care and support residential services are also increasing. We do not have enough nursing homes to take all our pensioners at the moment. So as a result, the government is increasing the amount of money and assistance they're giving to people to stay at home. So all that is costing the government a lot more money. So they've decided the best way to go about it is to reduce the amount of money people can have before they start getting the payments. So the payments will never cut out, but some people will have to wait a lot longer to get them. So at the moment, the full age pension, if you're single, is $877.10 a fortnight, or $22,805 per annum. Or if you're a member of a couple, the maximum payment you get is $661.20 a fortnight, or $17,181 per year. And that is all affected by income and assets tests. So you may have a partner who's working, which means you may qualify for very little or no pension. Now, the pension in the past few years includes the basic pension, the pension supplement, and the energy supplement. So in the old days, we used to pay quarterly installments for the energy and pension supplements. They've all been rolled into one fortnightly payment now. Okay, to get any payment from the government, we have income and assets tests. So if you're a single person, you're allowed to earn $164 a fortnight from all sources. So it's savings, from work, whatever. And once your income hits $4,264 a year, we start reducing your payment by 50 cents for every dollar above that amount. Currently, the pension will cut out once your income hits $1,918 a fortnight, or $49,873 per annum. Now, I'm going to be a bearer of bad news here. This is still current and will not change, but regardless of who's in power, that will need to come down. If you saw the cricket girls are going to be paid $25,000 a year, that is the minimum wage in Australia. So currently a pensioner can earn twice what a single working age person can. And there are 2 million people on minimum wage in Australia. So the bad news is, I believe that will come down in the future. It may not come down for the next 12 months. The government's got a minority, but it will eventually, whether it's Labor or Liberal, that will come down. Income test for couples, you can earn $292 a fortnight, regardless of who's doing work or not, or $7,592 per year. And after that, you lose 25 cents for every dollar above that area, and the pension will cut out at $2,937 a fortnight, or $76,357 per year. Up until that point, you keep getting the pension. Okay, income includes gross earnings from employment, and it now includes salary sacrificed income. Up till about 5 years ago, we never included salary sacrificed income until the government found out some very clever people realised that New Start was based on work only. So they salary sacrificed their entire salary and got the full New Start. So as a result, the government now counts any salary sacrificed income regardless of the person's age. Everyone these days has income from overseas, whether they realise or not. It could be through their superannuation fund, direct investment, or pensions if they worked overseas. So we look at all overseas income. Income streams of superannuation pensions, if you are receiving them, we assess them different ways depending when you went onto the system. We look at net rent from real estate and net income from farms and business income. Now, I will warn you, Centrelink's assessment of business income is different than the tax department, because we don't allow depreciation and other things like that. And we do what's called deemed income and financial investments. In the 1980s, the government used to look at what you actually had in investments, and we'd calculate the income. Now, Paul Keating realised people were putting money into cheque accounts to avoid interest, so he brought in what's called deemed income. So regardless of whether you have your money under the bed, you have in a cheque account, shares, we are going to apply the same rate of interest across the board to everyone. So it's in everybody's best interest to try to get the best rates they can. So the way we do that is we amalgamate your cash, your shares, bank accounts, investments, loans you may have made to people, income streams depending on what type you've got or when you started them. So if you're single, your first 49,200 is assessed at 1.75%, the rest at 3.25%. If you're a member of a couple, your first 81.6 is assessed at 1.75, the rest at 3.25%. Now that is irrespective of what you actually receive. So for instance, if I was age pension age today, my super fund last year, net of taxes, gave me 15%. If I was a pensioner and I still had that fund going, I would still only be assessed at 3.25% of that fund. So it can be a benefit to people who have got investments in that area. Now, having said that, you really need to be careful of where you invest your money, because if somebody's giving you more than 2% above where the banks are, it's a higher risk. If a bank is paying you 5%, they're lending at least 7 and 7.5%. So if somebody's giving you 7%, they've got to be lending at 9+%, which means they're lending to a riskier crowd. So you need to be careful, because you may have seen where the Building Society crashed in Bendigo a couple of years ago, where the seniors investment firm crashed and took $2 billion. You lose that money, that's it. You're not going to have anybody refunding it. So yes, chase the best possible returns, but be careful you're not going too far outside what's the average rates. I'll give you an example of how deeming works. We have Brian, he's a single male. His bank account is paying him 1%, so he's got $45 a year there. He's got term deposits paying him 3%, and he's got $28,000 in shares which are paying him dividends. Now, this calculation here only includes his dividend payment. It doesn't look at any franking credits, so his income may actually be higher than $149 a fortnight, but we're taking his actual income that we will see. So he gets $149 a fortnight. Using the Centrelink method, we're calculating him at only having $102. So he's actually got $47 a fortnight that we will not count as his income. And if he happens to have better investments than that, he could be having a much higher income, which we won't count. And if you take franking credits into account, which is another 30%, he's possibly got $180 there, but we're only going to count $102. So as you can see, there are ways that you can try to maximize your position to improve it. Okay, the asset test. Asset test looks at everything you own. That includes your clothes, includes your jewelry, your carpet, and that counts as your contents in your home. Now we have different thresholds for homeowners and non-homeowners. So if you're a homeowner, you can have less than assets than somebody who doesn't. Now assets at the current rate will reduce $1.50 for every 1,000. Now that's going to change in 1 January 2017, and we'll cover that a bit later. So assets include your motor vehicles, boats, caravans, etc. So it's household contents and personal effects, so your jewelry counts. Okay, we look at bank accounts, investments, loans you've made to family and friends. We look at real estate. With real estate, it is a net value. You have to be aware of that if you have a loan for the property, we will take the value of the loan off the property. Same as far as the businesses. If you have business-related loans and that, we take that off. If you have antiques to collectibles, it's wise to tell Centrelink, because we will actually pay a value to value for you. And the reason we started doing that is because during the 1980s, people were buying mahogany furniture and expensive wood furniture. It was actually worth maybe $10,000 a table. Today, that same furniture is worthless because it does not suit most modern houses being built or units and flats. And as a result, people can't give the stuff away. So Centrelink will actually value to make sure that you have got it correct. And gifting, Centrelink does not want you giving your money away to increase your pension, so they actually penalise you if you gift, and I'll cover gifting later. Now, one thing I need to emphasise to you is valuations. Centrelink do not know what your car is worth. They do not know what your furniture is worth. So if you come in and you tell us your car is worth $20,000 today, fine, we'll accept that, but you need to update it regularly. We don't know that your car has been in an accident or what it's worth today. For instance, I had a gentleman the other day, he put his car, which was brand new at the time, at $20,000 in the system. He had not changed the value once in 11 years. When I saw him the other day, his car is pretty worthless, but we still had his original purchase price on the system. So it is up to you to make sure you update. We do not chase you to update your things. And the other thing a lot of people make a mistake about is they put the insured value of their contents. That is not the value you get for your contents. I can tell you now, I have a 4-bedroom home with kids. They have computers and TVs in every room. I'm insured for $140,000. in all honesty, I'd be lucky to get $5,000 because nobody buys second-hand bedding. Nobody will take second-hand furniture these days. Even the salvos won't take electronic equipment because if somebody electrocutes themselves, salvos are to blame. So realistically speaking, you'd be lucky to get $5,000 for your furniture. So I would not be putting 15, 20, 30, 40,000. I actually saw somebody with $100,000 of furniture. Well, that reduces under the current pension. If you say your furniture is worth $100,000, you'd lose $150 of pension. Okay, so it's up to you, but you need to be realistic about your valuations. Okay, assets we don't include is a home you live in on up to 2 hectares of land, or 5 acres in the old language. Now all needs to be in the same title. Now, if you do have more than 2 hectares or 5 acres, and it's in the one title, and you've lived in the property for 20 plus years, we have what we call an extended land use test, which means we can exempt the entire land. So to give you a couple of examples, I have a lady in Hillsville. She's a 200-acre property. She legally cannot clear the land to farm it or make best use of it because there's a protected bird species in the land. As a result, because she's lived there for 20 years, the government's excluded her entire 200 acres from the asset test. We also, for those of you who know it, Moree, there's a gentleman up there, there's a 100,000-acre cotton farm. He has lived there his entire life. Because he is renting the farm out to somebody else to farm, we can exempt the whole 100,000 acres for him. Okay, so there are exceptions, and it's important you check with your local Centrelink office about the exemptions. And if you're not sure, see a FIS officer, because you are allowed to object and ask to have things reassessed. And in all honesty, it is worth it. I've met quite a lot of people who have objected, and I had one gentleman, he objected 3 times. They got sick of him. They sent him to see me, and within 5 minutes we worked out he was correct, and Centrelink had to backdate his payment 6 months. So don't give up and think, oh, it's too hard. It can be hard, but if you think you're right, verify it. Okay, assets we don't include: accommodation bond paid for aged care. If you go to aged care, most places these days are charging up to $550,000. That money cannot be accessed by you. They actually get to keep all interest on it. So Centrelink will exclude that when it's paid. So if you're a member of a couple or even a single person who's paid the bond, that is no longer part of your assets. Funeral bonds up to $12,500 per individual are exempt, and they will grow over time, but we only look at the price that you purchase and we exclude them. Prepaid funerals, there's no limit. You can go buy a mausoleum for $100,000, you can prepay a funeral for $35,000. The only word of caution I'd put there is make sure that if you prepay a funeral, the funeral service you go with is interstate. Because a lot of people in Victoria are moving to New South Wales or Queensland when they retire, and if they've prepaid a funeral, they may have to find their body's going to be shipped back to Victoria if they were the funeral pilots only in Victoria. So if you're prepaying, make sure they're everywhere. Special disability trusts are special trusts to assist disabled people. They are actually one of the best things the government has done in the last 10 years, because what we're finding is disabled people are living a lot longer, and as a result their carers are finding that they are having to go into aged care and they cannot look after them. These trusts are designed to allow somebody who's disabled to get a gift of up to $500,000 from a relative or somebody who's in aged care and going to care, and that does not count as their asset, and it doesn't count as the asset for the person under the gifting rules. We actually have a separate seminar on that, so I won't spend too much time on it. Superannuation rollover investments, if you're under pension age, we do not count them. If you happen to hit pension age and you have them, we can ask for ministerial exemption. So for instance, as a public servant, if I work more than 10 hours a week, I'm not allowed to access my superannuation. If I wanted to have it exempt, I would need to apply to the minister and say I want to keep working. I don't want my superannuation to affect any potential pension payments. And if the minister agrees, he can give me an exemption and Centrelink will not count my super. Okay, example we have here, Paul is 65, his wife Jill is 58. Super in Jill's name is not included in assessing Paul's pension age. Okay, so we've actually had people, like Paul, who's older, he could transfer legitimately some of his super into Jill's name and have it excluded from the asset test, which would give him a higher pension. and therefore could grow until Jill hits pension age herself. So there are different ways of doing all that, and you can see your local FIS officer about how to go about some of that. Okay, currently the thresholds, if you're a single homeowner, above $209,000 your pension will start reducing and cut out at $793,750. If you're not a homeowner, you're allowed to have $360,500 and the pension cuts out at $945,250. If you're not a homeowner who's paying for rent assistance, you're going to have another $150,000 before the pension cuts out. If you're a member of a homeowner couple, excuse me, you're allowed to have $296,500 in assets before we start reducing, and your pension will cut out $1,178,500. If you're a non-homeowner, you can have $448,000 as a non-homeowner couple, and the pension cuts at $1,330,000. And once again, if you're getting rent assistance, you can have extra $150,000. Now, the threshold point there is indexed every 1 July. So every 1 July will increase the threshold, and the cutout point is indexed every March and September. So effectively, the age pension gets an increase 3 times a year. At the moment, if you're on the asset test and you're getting New Start or widow's allowance or any of those other payments, your thresholds are at the threshold only. There's no amount above. So a single homeowner cannot have more than $202,000 in assets. One single dollar above that is out. Okay? And now these thresholds have been frozen until 1 January 2017, and the government has decided that they will increase that in line with the age pension thresholds from 1 January. Now, from 1 January, you're going to have higher thresholds, and they're also increasing the pension taper test. So instead of $1.50 per thousand, you're now going to lose $3. Now, what I've been telling everybody that I've spoken to physically, personally, is if you change your assets downwards by $1,000, you need to change it in Centrelink because it's going to be $3. If you go out and you buy a new car, well, you're going to pay stamp duty. You're going to pay registration. You're going to pay delivery fees. You may have spent $40,000, but your actual car value may only be $34,000 after you've paid all those fees, which you cannot get back. So unless you tell Centrelink everything properly, that $6,000 could cost you $18 instead of $9. Okay, so it's up to you to make sure you keep those limits in mind and update everything as soon as it changes, because it can make a big difference for you going forward. Now the new rules, we're going to be allowed to have $250,000, so it's increasing the amount, $250,000 before it cuts out, but it's going to cut out much earlier at $542,500. So we're going from a decrease of $719,000 for where you were $793,000 to $542,000, so that's a drop of $251,000 for a single person. A non-homeowner couple is going to go to $742,500. A homeowner couple will go to $816,000, and non-homeowners to $1,016,000. It's a pretty decent hit in the pensions. Now, the government's doing this to force people to use up their superannuation and everything else earlier, because they're going to have a massive problem as the population increases. And this current generation will eventually have super. My generation, a lot of them, because super didn't get implemented until 1990s, and it was only 3%. So some of the people currently in pension won't have much super, but future generations will have quite a bit of super if they work full-time throughout their lives. So the government is going to be making sure you use up your super before you ever come on the pension. Now, when you apply for any payment in Centrelink, we have no idea what you have. So we assume you're going to get the maximum rate. We then apply the income test, we apply the asset test, and whichever is going to give you the least amount of money when you apply is the one that you are paid under. Now, you will not always stay on that test, because you might be working part-time when you come onto the pension, so, or any payment which it would give you. So you might be under the income test. You may stop work for a reason. You could go to the asset test. Or you could have a lot of superannuation when you start, so you're in the asset test. As you use up your super, you could go to the income test, because we're deeming income. So you're not going to stay in the same test all your life. You will find you will chop and change you. Okay, so on 1 January 2017, anyone who loses a pension due to these changes will be granted a Commonwealth Seniors Healthcare card if they're over 65, and a low-income healthcare card if they're below, whether they're below 65 or over. they will get those 2 cards at 65 or over, the healthcare card only if they lose it. Now, these will be issued permanently. So you will not need to apply every year like everybody else for it. You will have it until you re-qualify for the age pension. And look, the only difference between that for a pensioner that you will not get is the council rates and the motor registration third-party accident. So you get everything else. So it's actually quite beneficial for people who are losing the pension still get the medication, especially because the vast majority of people I see, they're more concerned about the medication costs than they are about anything else. Excuse me. Okay, there's an estimator on the system, so if you go into, in this case we're doing older Australians because the majority of people are going to lose it, but you'll find it under other sections. But if you go to the asset test estimator, which is this one here with the arrow is at the moment, that will allow you to go in and put your amount in. So it's simple as this. You go in, you press with your single apartment, whether you own your home or not, and your total assets now, hit the estimate button, it'll give you an idea of what your pension will be. As you can see, it's got age pension, care payment, disability support pension, widow B and wife pension. So it will give you a pretty accurate idea of where you will be. Okay. Now, we've got some examples of the changes and how they'll impact different people. So for instance, if you're single and you're a homeowner, at $250 at the moment, you'd only get $815.60 in pension. From 1 January, your pension will rise to $877.10, so you get the full pension under the new limits. If you're a homeowner, there'll be no impact for you until you hit $400,000, and then a non-homeowner will go to the full pension instead of $817, they'll go $877. Now, the big difference is, at the moment, a homeowner will cut out $542, so they're going to cut out after getting $542, so they'll cut out pretty early. A non-homeowner won't cut out till $742, so they'll be able to have a bit more, but those are the new limits that will cut you out from 1 January. If you're a member of a couple, if you have $300,000 now, you're getting $3 less than the full pension. That will go to the full pension from 1 January, and people who are on non-homeowners won't be impacted until they hit $500,000. And then once again, at $816, the pension will cut out for homeowners, and at $1,116,000 for non-homeowners, unless they've got rent assistance. So you can see there's going to be a pretty big impact for people that are going to lose the pension a lot quicker. Now, some examples we've got here. Karen and Rob aren't working. They have no income supports paid them because they're homeowners and have $325,000 investment property. From 1 January 2017, Karen can claim parenting payment and Rob can claim a new start allowance because we're increasing the amount that they can have in assets before we change it. Sorry, don't pay them. Another example, Betty is a homeowner. She has $240,000 in a grandfather account-based income stream and home contents worth $5,000. Because she's got $245,000, she's not in the full pension. She's only getting $823 a fortnight. From 1 January, she'll get the full age pension because she'll be below the $250 cut-off point for a homeowner. So there are people who will benefit and there are people who will lose out. Currently, we're predicting that 96,000 people will actually lose the payments and another 315,000 will have a reduction. Okay, another example, John and Beryl, they're homeowners who have $350,000 worth of investments subject to deeming and $25,000 other assets. So under the asset test, they each get $606.07 a fortnight. If they're income tested, they get $636.59 each. So Centrelink always pay the lowest amount, so we pay them under the asset test. Come 1 January, the asset test will pay them $661.20, so the government will start paying them under the income test because they will always pay the lowest amount of pension they can. Now, John and Beryl consider investing some money in long-term annuity as they do not get the maximum rate of pension at current deeming rates. If they do that, the income tested rate will still pay them $636.59 because the annuity will still be, $636.59 because the annuity will still have income assessed against it. An example of a single man here, Dean has $600,000 in account-based income stream and draws $1,500 a fortnight. Under current rules, he gets $250 a fortnight in age pension and he has a pension concession card. come 1 January, his pension will automatically be cancelled because he's over the assets test. He will receive a Commonwealth Seniors Healthcare card and a low-income healthcare card automatically, and they will be until he regains the age pension, which, depending on what he does, could be fairly quickly, because he decides he's going to increase his account-based pension by $300 a fortnight to make up for the loss of the pension. Now that means he's going to draw down his asset quicker, and when he comes back below the new asset test limit, whatever point in time that comes down, he will re-qualify for the pension. You only have to be $1 below the cut-off point to go back on the pension, and then as your assets decrease, your pension will slowly increase until eventually you get back on the full pension over time. Another example, we've got Maria and Tony. Their investment property is worth $680,000, and they have $20,000 in other assets. Their rental income is $800 a fortnight. They each receive $358.57 per fortnight age pension. From 1 January 73, the age pension will be reduced to $173.70 each because of their assets. And Maria and Tony can borrow more age pension under the pension loan scheme if they feel that they haven't got enough income. What the pension loan scheme allows you to do is, in their case, with the pension being $656, they can go from $656, they can borrow, very quickly, sorry, $357, they can each borrow $473 a fortnight from Centrelink, and they secure that against an investment property or their home property. And they can have that for life, or until they might win tax lottery, they want to cancel it, or they may move into the aged care or sell a property. Once they sell a property, they need to repay the loan. But that amount is only charged at 5.25%, and has been since 1990. So it's a pretty cheap way of getting extra money. And unlike a reverse mortgage, it doesn't build up forever and then one day take the whole value of your home, because it will only go up by the rate of amount you're drawing and 5% interest a year compounding. To get the pension loan scheme, you have to qualify for the age pension under either income or asset test. So even though you don't get it, if you are eligible for the pension under one of the tests, we can then give you a pension top-up if you want, or pay you the pension under that. You have to have real estate in Australia, and the pension payable is nil or below the maximum rate. You can top up the fortnightly payment to the maximum rate of age pension, so it'll depend on whether you're single or a member of a couple. And amount borrowed with interest and fees is repaid when you sell the real estate or you move out of your home to go into a aged care facility. So if you want more information about that, if you talk to your local financial information services officer, they can explain the whole thing and organise for you to get the forms if you decide you want to go ahead with it. It is a good cheap alternative for people who own their home but don't wish to go borrow against the house through a reverse mortgage, which can basically wipe your house out in 20 years, paying the interest rates. Other things to consider is that the government is going to increase the amount that you can have before you go into a granny flat. At the moment, if you go into a retirement village or buy a granny flat for less than $151,000, we count you as a non-homer and we can give you rent assistance. They're going to increase that $200,000. So if you move into a retirement village or a granny flat and you pay less than $200,000, you will get rent assistance if you pay it. Your pension may be cancelled as a result of cancellation of your carer's payment. So if the person you're caring for gets pension cancelled, you can lose your carer's payment as well. Okay, so you need to look at that. The amount of pension bonus scheme may be affected. So if you're in the pension bonus scheme now, make sure you see your FIS officer and work out whether or not you should be claiming now, because everybody I've seen so far is going to have a reduction in the pension bonus scheme because the asset test is going to reduce them so much. So it's worth possibly claiming now, getting kicked off the pension in January, but you still get your pension bonus at the higher rate. Okay, it can make a difference of up to $20,000 for some people I've seen so far. And also aged care fees may change if the person's rate of age pension changes. So if your pension goes up, your assessable income may go up, so you may have to pay more fees. If you lose your pension goes down in the asset test, you may find you have a reduction in fees. Now the government assesses the fees every quarter, so you may not notice a difference immediately. It may be the following quarter you notice a change in your fees, but they will advise you. Okay, you can reduce your assets by spending. You can gift up to $10,000 in any one financial year, but no more than $30,000 in a 5-year period. Now look, I personally wouldn't spend just for the sake of it. I've interviewed a gentleman this week. He is looking at spending money in his house and everything, but unless you really need to do those things, you're better off having more money. In his case, he's going to re-qualify for the pension within about a year, but he wants to spend $60,000 now to stay on the pension. He's only going to get the salary supplement, so to me it seems silly, but he's going to do it. You can prepay a funeral if you haven't already done it. You can buy a funeral bond if you haven't done it. As I said, you can improve your principal home if you need to, and you can contribute to superannuation if you're underage pension age. So if you're a pensioner and you have a younger partner, you can contribute money to your partner's account, and that will not count until they hit pension age. So there are different ways of legitimately reducing your assets. Now remember, giving away or spending $10,000 might increase your payment by $780 a year, but that's going to take you about 20 years at $280 a year in interest to get that back. So as I said earlier, if you don't need to give it, avoid it because you're shortchanging yourself. And as I said at the very start, 1 in 10 Australians will reach 103 if they're female, 100 if they're male, so you do not want to be giving your assets away because you could be living a very impoverished lifestyle in the future. In summary, any adjustments of rates of payments happen automatically from 1 January 2017. So you should notify if your circumstances have changed. Centrelink have got staff working overtime at the moment trying to update everything humanly possible. And given the fact that we've got the Christmas period and that coming up, you need to make sure you've done all your changes prior to Christmas, because by then it may be too late, because we're going to have Boxing Day, Christmas Day and New Year's coming shortly after that. So get any changes and updates you need to do done now if you can, please. Raise an asset test threshold advantage of some subject to the income test. Allowees will need to claim because of the rise as well. People whose payment is cancelled 1 January due to the change of the test will automatically issue a concession card. Anyone who's cancelled on or after 1 January will not get it. So make sure you get all your changes done now, so that if you do qualify for it, you qualify before 1 January.
Ring MS Connect, send us an email, or ring up Centrelink and talk to a financial services information officer. So I hope you enjoyed today's presentation, and thank you, Mirko, for your time.
No worries.
And we'll leave it there.
Okay, thank you.
Thank you.